This lecture is about goodwill on admission of a new partner in a partnership business. It covers the following areas: admission of a new partner based on introductory issues about admission of a new partner, accounting for goodwill, which will be based on two areas: a situation where a goodwill account is opened and maintained, and a situation where a goodwill account is not maintained. Let us start by a recap in which we shall be looking at changes in partnership. These changes in partnership had been dealt with in a previous lecture. So please find time to look at the previous lecture, which deals with introduction to changes in partnership. However, to look at them briefly is that we understand that there are several changes in partnership business, but there are major changes which, when occur in a partnership, then the partnership is as good as dissolved and reformed. Such changes affect the partnership agreement significantly. That is why the partnership business is considered dissolved and formed again. The changes include admission of a new partner, retirement of an existing partner, and change in profit sharing ratio. Now let us focus on a situation where a new partner has been admitted. When a new partner has been admitted, goodwill must be revalued. Goodwill is revalued to determine the value that has been created by existing partners before the new partner is admitted. Now, once goodwill has been revalued, then the new partner may be asked to pay for his share of goodwill in cash. Or if the goodwill is not paid for in cash, the existing partners are credited with share of goodwill in their all profit sharing ratio. Also, a goodwill account may be opened and maintained, or a goodwill account may be opened and written off. So these two situations exist in a situation whereby a new partner has been admitted. Let us start with the first situation, in which a goodwill account is opened and maintained. In this case, the goodwill account which is opened is credited, or the goodwill which has been valued is credited to the existing partners' capital account in their all profit sharing ratio. This goodwill is an equivalent of the value that has been created by these partners before admission of the new partner. Because of that, the new partner will not have a share of the goodwill because it is a value which belongs to the existing partners. Right. In a situation that goodwill account is maintained, the following accounting entries are made. To record goodwill, debit goodwill account with the value of goodwill which has been determined, and credit the partners' capital account, especially for the existing partners or the old partners, with their share of goodwill in the all profit sharing ratio. A situation may occur whereby a goodwill account was already opened before, and now upon admission of a new partner, the value of goodwill is determined to have increased. If the value of goodwill increases, then debit goodwill account with increase in the value of goodwill, and credit capital account, partners capital account for the all partners with their share of increase in goodwill in the all profit sharing ratio. A situation may also exist in which there was an existing goodwill account already created, and upon valuation of goodwill, when a new partner is being admitted, we realize a decrease in goodwill. In such a case, debit the partners' capital account for the all partners with their share of decrease in goodwill in the all profit sharing ratio, and credit goodwill account with decrease in goodwill. Now, the next situation is where goodwill account is not maintained. Goodwill account is not maintained means it may be opened and then written off. In this situation, we understand that goodwill is an intangible asset. And because of that, some businesses may prefer not to maintain it in the business. And in that case, they write it off immediately. The new partner may be required to pay an extra cash or have his capital balance reduced for a share of goodwill. Now, accounting entries that support or that support this particular activity, accounting entries include the following. If goodwill account is not maintained in the business, then the accounting entries which have to be made include the following. To record goodwill, debit goodwill account with the value of goodwill, and credit partners' capital account for the all partners only with their share of goodwill in the all profit sharing ratio. Then goodwill is written off because it is not supposed to be maintained in the books of account. To write off goodwill, debit partners' capital account for all the partners. That is the all partners and the new partner who has just been admitted. Debit all their partners' capital account with the goodwill written off, the share of goodwill written off for each partner in their new profit sharing ratio, and credit goodwill account with the total goodwill written off. To illustrate the two situations, the following example will be used. David and Collins were partners sharing profits and losses equally. On 1st January 2021, they admitted Adrian as a new member who was required to introduce 600,000 as capital. The profits are now to be shared among David, Collins, and Adrian equally. Goodwill was valued at 300,000 on 31st December 2020. The statement of financial position of the firm before admission of the new partner was as follows. Assets 1.2 million, capital accounts for David 600,000 and Collins 600,000. Required. Partners capital account and statement of financial position immediately after admission of Adrian. To answer this question, we can use two approaches. The first approach is where goodwill account is maintained in the books, and the second approach is where goodwill account is written off. Now let us look at how the solution of the question looks like. Starting with the first approach where goodwill account is supposed to be maintained in the books, these are the accounts to be prepared. The first one is goodwill account, and in goodwill account, goodwill will be recorded. The second one is partners capital account. And then we will prepare the statement of financial position. Now, the first entry is the capital balances brought down. The first entry is the capital balances brought down from the previous period. Now we have balance brought down of capital account. The balance brought down of capital account equal to 600,000 for David and 600,000 for Collins. There is none for Adrian. After that, we record the goodwill valued. The goodwill valued is recorded in the goodwill account, is entered on the debit side of goodwill account as capital account. So goodwill is divided between the existing partners in their profit sharing ratio. The all partners who are existing are David and Collins. David will have 150,000 of the share of goodwill, because goodwill is a total of 300,000. So shared equally is 150,000 and 150,000. And that amount is supposed to be credited in the partner's capital account as goodwill. $150,000 for David and 150,000 for Collins. There is none for Adrian, because Adrian is just being admitted. Then the capital introduced by Adrian into the business will be recorded as bank or cash. The amount is 600,000. That is for Adrian. Now, in this situation, goodwill is maintained in the books. Because of that, we're going to have a balance carried down for goodwill. Balance carried down for goodwill, which is equal to 300,000. So that we balance off this account to 300,000. 300,000. The capital account is also balanced off. And in balancing off the capital account, we have balance carried down. The balance carried down for David is the total for David, which is equal to 750,000. So we have here 750,000 and write the total. The balance carried down is 750,000. For Collins, also we have 750,000 as the total. So the balance here is 750,000 and the total 750,000. For Adrian, the total is 600,000. So the balance carried down is going to be 600,000 and 600,000 as the total. This is how to prepare the partner's capital account and the goodwill account on admission of a new partner, where goodwill is to be maintained in the accounts. As you can see in this case, Adrian did not introduce any amount which is for goodwill, but goodwill was just revalued and shared between the existing partners. Then the statement of financial position after admission of Adrian then will look like this. We start with the assets. The assets that were there in the business before admission of Adrian, as you can see, is a total of 1.2 million. This is the assets that were there before admission of Adrian. So we have assets of 1.2 million. But during admission, Adrian brought in cash, which was 600,000. So that the total is going to be 1.8 million. Then another asset is goodwill, which is now intangible asset. Goodwill was valued at 300,000 and is carried in the books. That is why you can see it in the statement of financial position. Then this is financed by, it is financed by capital accounts. Capital accounts for David, Adrian, the second partner is Collins, and then Adrian. The capital account for David is having a balance of 750,000. And what we transfer to the statement of financial position is the balance carried down. So you can see the balance is carried down here. Those are the items that we transfer to the statement of financial position. So for David is 750,000. For Collins is 750,000 also. And then for Adrian is 600,000. Then the total is going to be total is going to be 2.1 million. The same as what we had in the assets, the total is 2.1 million. Right, so that is how to prepare the statement of financial position. In this case, we have started by preparing the goodwill account and the double entry of the goodwill being done in the partner's capital account. Then prepare the statement of financial position where the assets have been recognized and goodwill has been carried here because the goodwill is maintained in the books. And then we have the capital accounts as the financing. This is a situation where goodwill is maintained in the books. Let us look at the second situation. And this will be a situation where goodwill is not maintained in the books of account. That is a situation where goodwill is written off after creation. So goodwill will be written off after creation. It is a situation where we can as well not open the goodwill account. We can as well not open the goodwill account. We just go straight away to opening the partner's capital account, and then we record goodwill there and write it off. It is a situation where goodwill account is not opened, or if opened, is written off after opening. So let us show the goodwill account and show what happens in it and how it is being written off. As I've said, some books avoid preparation of goodwill account in such a situation. They just go ahead and prepare the partner's capital account without preparing goodwill account. But for purposes of learning, I would like to show you goodwill account and how it is then treated after it has been opened, or how it is written off after goodwill account has been opened. This is the partner's capital account with the three partners, as we have. Partner's capital account. We have David, Collins, Adrian. David, Collins, Adrian. Right. Start by recording the opening balances, which are the balances brought down. 600,000 for David, 600,000 for Collins, and none for Adrian. Secondly, we record goodwill. Goodwill is debited here as capital for David and Collins. The share is the same, 150,000 and 150,000. And then credit the goodwill in partner's capital account. So we have goodwill, 150,000 each. The next step is to record the cash which was introduced by Adrian as either bank or cash. And that amount is 600,000. After recording that, we need to balance off the account. And as we balance off the accounts, we write off goodwill, because in this case, goodwill is not maintained in the books of accounts. Now, to do that, start with the goodwill account and write off goodwill into capital account. As we write off goodwill, we write it off between David, Collins, and Adrian. Now we have all the partners are going to share in the writing off of goodwill. This is because now we use the new profit sharing ratio after the partners have admitted the new partner. We are told that after admission of the new partner, goodwill is still shared equally. Profit and losses are still shared equally. And because of that, goodwill will also be shared equally among the partners during writing off. Goodwill is 300,000, and therefore, if shared equally among the three partners, each partner will have a share of 100,000, 100,000, and 100,000. And that amount is debited in the partner's capital account, and we call it goodwill written off. Goodwill written off 100,000, 100,000, 100,000. Then we can just go ahead and balance off the goodwill account with 300,000 as the total. And now there is no balance because goodwill has been written off. Next, we balance off the partner's capital account. In the partner's capital account, having already written off 100,000 from each partner, now this is what is going to remain. For David, the total is 750,000, already written off 100,000. So the balance carried down is 650,000. For Collins, the total is 750,000, already written off 100,000. Therefore, 650,000 is remaining. And for Adrian, the total is 600,000, already written off 100,000, remaining 500,000. So the total here is 750,000, 750,000, and 600,000. That is after goodwill has been written off. Now, let us prepare the statement of financial position to show the effect, because now we don't have goodwill in the books. Then how will then the statement of financial position be prepared? Let us have David, Collins, and Adrian. Statement of financial position. As at 1st January 2021. That is immediately after admission of Adrian, because Adrian was admitted on 1st January 2021. And in this statement of financial position, we start with the assets. And the assets that were there in the book before admission of Adrian were 1.2 million, as you can see there. So we have 1.2 million as the assets. But then Adrian brought in 600,000 as his share or as his capital. The total therefore becomes 1.8 million. And in this case, because goodwill has been written off, there will be no goodwill because goodwill has already been written off. So we just have a total of 1.8 million as the total assets. Then that is financed by capital account for the partners. And the capital accounts are for David, Collins, and Adrian. So for David, the capital balance, and we are taking the balances carried down, as I said, we will be picking the balances carried down in the partner's capital account. As you can see there, that means for David, the balance carried down is 650,000. For Collins, 650,000. And for Adrian, 500,000. And the total of this is 1.8 million. That is how the statement of financial position now will look like in a situation where there is no goodwill maintained in the book. So we will not show goodwill in the books because it is not maintained in the books. It has been written off. Thank you for watching this lecture. Please look at other lectures on partnership and other lessons or other topics that I will post going forward.